Every year in late January and early February, something happens across America that is treated as unambiguously good news. The tax refund arrives, people celebrate it, they screenshot it, they post about it, they plan what to do with it, the vacation, the credit card payment, the new couch, the emergency fund they've been meaning to start. According to IRS data from the 2024 filing season, the average federal tax refund was $3,011. Total refunds issued exceeded $320 billion. Hundreds of millions of Americans were getting money back from the government, and the overwhelming cultural narrative was that this was a positive financial event. It isn't. A tax refund is not a bonus. It is not a gift. It is not the government doing you a favor. It is the return of money you overpaid, money that belonged to you all year, that you gave the federal government interest-free, that sat in the U.S. Treasury earning nothing for you, while it could have been reducing debt, building an emergency fund, contributing to a Roth IRA, or compounding in an investment account. The government collected it, held it for up to 15 months in some cases, and returned it without interest, without apology, and without any acknowledgement that you made an error that cost you money. I'm Stella, this is Stella Insights, and what I'm about to show you is exactly how much that error costs. Not in a single year, but across the time horizon where the real damage happens. The math most people never run. The irony is almost mathematical in its precision. The people most excited about their tax refund are often the same people most likely to be struggling with emergency savings, credit card debt, and underfunded retirement accounts. They have been accidentally lending the federal government several $1,000s at 0% interest for a year, while paying 22% on their credit card balance and earning 0.39% in their savings account. The person celebrating a $3,000 refund while carrying $3,000 in credit card debt paid approximately $660 in interest over the year on debt they could have eliminated if those withholding dollars had stayed in their paycheck. Meet Daniel. He is a 34-year-old teacher in Columbus, Ohio. For 9 years running, he has received a federal tax refund. The amounts have varied, anywhere from $2,200 to $3,800, but the average has been right around $3,000. Every spring, he uses it to pay down his credit card, take a short trip, or cover a repair he'd been deferring. He feels responsible about it. He feels like he planned ahead. What Daniel has never done is calculate what those 9 refunds actually cost him. Over 9 years, Daniel gave the federal government approximately $27,000 of his own money interest-free, roughly $250 per month that never appeared in his paycheck. He carried an average credit card balance of $4,500 at 21% APR throughout this period, paying approximately $945 per year in interest, $8,500 in total interest charges over the 9 years. The refund he received in April each year helped pay it down, but the balance was back within months. The debt and the overwithholding coexisted for nearly a decade, each one financing the other's continued existence. If Daniel had adjusted his withholding 9 years ago and applied the additional $250 per month directly to his credit card until it was eliminated, which would have taken approximately 18 months, and then invested that same $250 per month in a total market index fund at 8% average returns for the remaining 7.5 years, he would have approximately $34,000 in his investment account today. Instead, he has $0 in investments, an intermittent credit card balance, and 9 happy memories of refund season. The $3,000 refund felt like a win every spring. The $34,000 he doesn't have is invisible. How the withholding system actually works. When you start a job, you fill out a W-4 form that tells your employer how much federal income tax to withhold from each paycheck. The amount withheld is an estimate, based on your filing status, number of dependents, and adjustments you specify, of what your annual federal tax liability will be. At the end of the year, you file a return that calculates your actual liability. If you withheld more than you owe, you receive a refund. If you withheld less, you owe the difference. Most people fill out the W-4 once when they start a job, never update it when their financial situation changes, and systematically overwithhold for years as a result of that inertia. The IRS provides a free withholding estimator at irs.gov that calculates, based on your actual financial situation, exactly what you should be withholding to end the year close to zero. It takes approximately 15 minutes to use. The result, adjusting your W-4 to align withholding with actual tax liability, immediately increases every paycheck by the amount you were previously overpaying. A household that typically receives a $3,000 refund and adjusts their withholding correctly gains approximately $250 per month in take-home pay. That $250 is not new money. It was always their money. They are simply receiving it monthly, rather than in a lump sum 15 months after they earned the first portion of it. The opportunity cost of systematic overwithholding compounds across a working life in ways the annual celebration of a refund completely obscures. Consider a household that receives a $3,000 refund every year for 30 years. If instead they adjusted their withholding and invested that $250 per month in a diversified index fund, earning 8% average annual returns, at the end of 30 years, they would have accumulated approximately $339,000. The refund amount was identical in both scenarios. The difference is entirely in timing. The household that kept the refund cycle intact turned $90,000 of their own money into roughly $90,000 of consumption over 30 years. The household that fixed their withholding and invested the monthly difference turned the same $90,000 into approximately $339,000. Same income, same tax liability. A $249,000 difference from one form adjustment and one investment account. Why people prefer refunds anyway. The psychology of why people prefer refunds despite this math is well documented. Researchers in behavioral economics have found that people systematically prefer lump sum receipts to equivalent amounts spread over time, even when the lump sum is smaller in total value. The refund feels like a windfall. 12 slightly larger paychecks feel like nothing. The $250 monthly increase in take-home pay is absorbed almost immediately into baseline spending. The $3,000 lump sum in April feels significant, memorable, and available for intentional use. There is a forced savings argument worth acknowledging honestly. For households that genuinely cannot be trusted to invest the additional monthly take-home pay, that would spend the $250 rather than save it, the refund cycle functions as an involuntary savings mechanism. If the alternative to the refund cycle is spending the $250 monthly rather than investing it, the refund cycle may produce a better actual outcome for that specific household, even if it's theoretically inferior. The goal should be to not be that household, to build the financial infrastructure that makes the monthly saving the default rather than relying on overwithholding as a workaround for spending behavior. But honesty requires acknowledging that the psychologically driven preference for refunds has real-world implications that purely mathematical arguments don't fully capture. Daniel spent 9 years feeling good about his tax refund. The math says it cost him $34,000. Most people watching this have never calculated their own version of that number. What do you think yours looks like? Rough estimate in the comments. And if you've already fixed your withholding, tell us how. The other tax money you're leaving on the table. The W-4 adjustment is the most visible missed opportunity, but there are several others that cost ordinary Americans significant money each year and get almost no cultural attention because they don't produce a satisfying annual moment the way a refund does. The retirement contribution gap. Every dollar contributed to a traditional 401k or traditional IRA reduces your taxable income in the contribution year, dollar for dollar. A person in the 22% federal bracket who contributes $5,000 to a traditional IRA reduces their federal tax bill by $1,100 permanently, not deferred. Many people who carefully adjust their withholding to avoid overpaying simultaneously fail to make retirement contributions that would reduce their total tax bill. They optimize the timing of their payments while leaving the largest available reduction entirely unused. According to Vanguard's 2025 How America Saves report, approximately 27% of 401k eligible employees contribute nothing to their plan. The IRS does not proactively inform them of this missed deduction. It simply collects the higher tax. The HSA gap. The health savings account, available to people enrolled in a high-deductible health plan, offers a tax deduction on contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. It is the only triple tax advantaged account in the U.S. tax code. The contribution limits in 2026 are $4,400 for individuals and $8,150 for families. A person in the 22% bracket who contributes $4,400 to an HSA receives an immediate $968 tax reduction. The HSA funds can be invested in index funds and left to grow tax-free for decades. The HSA is one of the most underutilized accounts in the American tax code, and its underuse costs eligible households hundreds to thousands of dollars annually in unnecessary tax liability. The Saver's Credit. This is a direct tax credit, meaning it reduces your tax bill dollar for dollar, not just your taxable income, available to lower and moderate income workers who contribute to a retirement account. In 2026, it provides a credit of 10%, 20%, or 50% of up to $2,000 in retirement contributions, depending on income, for single filers with AGI up to $40,250 and married filers up to $80,500. The maximum credit is $1,000 for single filers and $2,000 for married couples. According to the IRS, approximately 1 in 5 eligible taxpayers fails to claim this credit each year. These are workers who made retirement contributions, are entitled to a direct reduction in their tax bill, and leave the credit unclaimed because they don't know it exists. A $1,000 tax credit is identical in financial terms to a $1,000 cash payment. It is sitting in the tax code, available, uncollected. The capital gains rate most people don't know about. Long-term capital gains, profits from investments held longer than 1 year, are taxed at 0%, 15%, or 20% depending on income. For single filers in 2026 with taxable income below approximately $47,025, the long-term capital gains rate is 0%. Zero. Many moderate income investors do not realize that selling long-held appreciated positions while their income is below this threshold triggers no federal capital gains tax. This is particularly relevant during low-income years, career transitions, early retirement, part-time work. Strategic harvesting of gains in low-income years is a legal, legitimate, and almost entirely overlooked tax reduction opportunity. The proactive tax posture. The meta point that connects all of these missed opportunities is this: most Americans interact with the tax system exactly once per year at filing time in a purely reactive mode. They gather their documents, complete their return based on what already happened, pay or receive accordingly, and wait until next April to think about taxes again. The difference between reactive and proactive tax management across a working life is measured in hundreds of thousands of dollars, not because of exotic strategies, but because the basic tools available in the tax code simply aren't being used. A proactive tax posture looks like this. Review your withholding once per year using the IRS estimator and update your W-4 when circumstances change. New job, marriage, new child, significant income change. Maximize contributions to every available tax-advantaged account before December 31st, 401k to capture the full employer match, and as much more as possible. IRA, HSA if eligible. Check Saver's Credit eligibility if income is in the applicable range. Do a brief year-end review in October or November, when there is still time to act, rather than a retroactive accounting in April, when almost nothing can be changed. None of this requires an accountant for most households with straightforward situations. The IRS withholding estimator is free. The IRS Free File program provides free filing software for households with income below $84,000. The retirement account platforms at Vanguard, Fidelity, and Schwab provide contribution tracking and reminders. The tools exist. The decision to use them is the only variable. What to do this week? Daniel is going to fix his withholding this month. He ran the IRS estimator, found he's been over withholding by $260 per month, and submitted an updated W-4 to his HR department. Starting next paycheck, that $260 goes directly to his credit card. In 14 months, the card will be paid off. After that, the $260 goes into a Roth IRA. He's 9 years late, but the next 30 years of compounding are still entirely available to him. The 2011 average refund is not a victory. It is the visible symptom of a tax strategy, or more precisely, the absence of one, that costs the average American household real money every year through foregone investment returns, unnecessary interest on debt that extra monthly cash flow could have eliminated, and missed contributions to accounts that compound tax-free for decades. The celebratory screenshot in February is celebrating the return of a 12-month loan to the government, delivered without interest. The government is not your savings account. It charges nothing for the service and pays nothing for the float. Every dollar sitting in overwithholding is a dollar that isn't compounding for you. Getting a smaller refund, or better, owing a small planned amount, is not a problem. It is a sign that your money is where it belongs, working for you every month all year long. Adjust the W-4 tonight. If this video changed how you think about your refund, subscribe to Stella Insights. I cover the financial decisions that actually move the needle, without the noise. And if you know someone who screenshots their refund every February, send them this. It might be the most useful 2 minutes of their year. See you in the next one.